Can't get enough information about what valuable tax deductions there are that you might qualify to write off this year? Well, don't worry. I've got you covered. I'm Mark Steber, Chief Tax Information Officer at Jackson Hewitt. Each tax year, there are even more deductions that you can include on your tax return from tax law changes or even bigger, life changes. And there are tax breaks that could help you get an even bigger tax refund or lower the amount you owe the IRS. So let's dive in. In our recent video, we covered the basics of who is required to file a tax return and what's on a tax return. But just to quickly recap, the top 3 things you need to know are this. Most U.S. citizens need to file a tax return if they made more than a certain threshold of gross income that year, which is the amount generally based on your filing status. But even if you made less than that and you don't have to file, you should still consider filing a tax return because if you worked and had taxes withheld, you could probably get a tax refund. Or if you qualify for refundable credits, another reason to file, even if not required. A tax return is basically made up of 3 parts: income, tax deductions, and tax payments made and credits. From there, you combine all the various parts and true it up and boom, tax refund or taxes owed. Income is all the money you earned during the year. Tax deductions provide a benefit by allowing you to deduct a certain amount from your taxable income, which means you pay less in taxes. And finally, the taxes you paid in and any credits you might be qualified for get considered. And then the true up and any money you are due, tax refund, or any amount you owe, tax balance due. It's important to work with a tax expert who understands your tax situation. You might be a single parent, or in the military, or have self-employment income, or in a complicated life or work situation. These circumstances really should be looked at even more carefully. Otherwise, you could make a costly mistake on your tax return, which could lead you to getting a smaller tax refund or putting you in a hold with the IRS until your tax return is figured out. Mistakes are not just math error or leaving some income off. You can leave off tax benefits too, and the IRS will not just add them back and give you more money. Leave it off and it stays off. Unless it's income, and the IRS will fix that for you and send you a bill. So don't worry about the headache. Work with a Jackson Hewitt tax professional to make sure your tax return is filed accurately and includes every credit and deduction you qualify for. Because it matters who does your taxes, and we care. Today we're going to focus on more top deductions you might be able to use to reduce taxable income and increase your tax refund. Here are some of the top questions I get every tax season about tax deductions. Can your education expenses be deducted? There are great tax credits for college costs and higher education, near a dozen benefits in all, like the American Opportunity Tax Credit and the Lifetime Learning Credit. But there isn't a deduction, meaning you can't deduct the cost of your college, trade school, or other higher education classes. But there are credits available, which again give you a dollar-for-dollar reduction or tax benefit. Besides those 2 lucrative tax credits, there are literally a dozen other benefits. You cannot deduct everything you pay, but there are credits, contribution plans, work-related education, and even a student loan interest deduction. Are medical expenses tax deductible? I know this is an area we all spend a lot of money on, our health. And there's good news and not so good news. If you have medical bills that aren't covered by your insurance, you may be able to take a deduction on those expenses where they exceed 7.5% of your adjusted gross income. But to deduct medical expenses, you must itemize. You can't take the standard deduction. And while this is not many taxpayers, it is some. And if it is you, it can be very important. What you need to know is this. Medical expenses are hard to get on a tax return due to the 2 big requirements. First, you must itemize your deductions, and that's not many people these days with the big standard deduction. And secondly, you can only deduct the excess over about 7.5% of your adjusted gross income. So another haircut right off the top. You really need a lot of medical expenses, and then other deductions typically to go over the threshold. But if you're there, and unfortunately I know many are these days with significant illness and hardship, do not overlook medical deductions on your tax returns if you qualify. It is rare, and only a small portion of taxpayers take medical deductions on a tax return, but if it is you, it can be a big game changer on your taxes. What can you deduct as a medical tax deduction? You can deduct unreimbursed expenses for preventive care, treatment, surgeries, and dental and vision care as qualifying medical expenses. You can also deduct other medical expenses like medical copays, prescription, addiction services, in-hospital care, in-home health care, and visiting health professionals, dental expenses including braces and dentures, eye exams, prescription glasses and contact lenses, weight loss programs for doctor-diagnosed diseases, insurance premiums not covered by your employer, and more. What can't you deduct as a medical tax deduction? There are a few things that do not qualify as a medical deduction, including any medical expense for which you are reimbursed by either insurance or an employer, cosmetic or elective surgeries, not deductible, non-prescription over-the-counter medications, funerals and burial services, and a couple of more medical questions I hear often. Are Medicare premiums tax deductible? Yes, Medicare premiums are tax deductible if you itemize deductions on your income taxes if the total expenses exceed a certain percentage of your income. Are health insurance premiums tax deductible? Yes, health insurance premiums can be written off if you itemize deductions. In general, so long as the provided service is legal in the United States and promotes and maintains the health and well-being of a taxpayer, it is considered a valid health deduction. Here's a pro tip. Check out the IRS publication 502 for more details, or talk to a tax expert to learn more, especially if you have a lot of medical expenses. Are home improvements tax deductible? Yes, they can be, but not just writing off that new pool and hot tub or the new man cave and entertainment room. There are some sweet tax benefits for select expenses, and there are several factors to consider. First, you must own the home. You can't deduct expenses for a house that you rent. Second, general home improvement projects do not qualify as write-off, but they could qualify for a tax break when you eventually sell your home. Your home improvement tax deductions happen when you've made energy-efficient home improvements, including when you have renewable energy systems in your home. Not a deduction, but there are some sweet credits for the installation of a renewable energy system, like solar panels, solar water heaters, wind turbines, geothermal heat pumps, and more. And a credit means you'll deduct that amount from the taxes you pay this year, so you'll pay less. That's a pretty big deal for the current tax year. Starting January 24, there's a credit up to $3,200 for improvements made through 2032. The credit covers 30% of expenses like qualified energy efficiency improvements installed during the year. You've made home improvements for medical reasons and to accommodate a disabled family member, such as adding ramps or widening doorways. You may be able to deduct these costs as a medical expense. If you're self-employed and use part of your home exclusively for your business, you can maybe take a deduction for your home office. And if you've made capital improvements to your home, meaning you've added value to your home to prolong its useful life, you can reduce the amount of gain as taxable income and ultimately taxes that you owe when you sell your home. It won't be immediately deductible, but it is a huge issue if you own a home. So keep track of your improvements because it can matter. If you've made improvements that extends the life of your home, like a new roof, windows, water heaters, these too are very important for your basis, but not necessarily an immediate tax deduction. And as I said, this is critically important when you sell your home someday. It can make a big difference, and it's hard to go back and figure out. So keep track as you go along. Are retirement contributions tax deductible? Well, yes, you can contribute up to $7,000 to your individual retirement account, or IRA, if you have earned income from a job or self-employment and you're under the age of 72. If you're 50 or older, you may contribute as much as $8,000. Your traditional IRA contributions may be tax deductible. The deduction may be limited if you or your spouse is covered by a retirement plan at work and your income exceeds certain levels. Saving for retirement is one of the biggest and best ways to cut your taxes, save money for your future, and use the tax code for saving money. It's not just a rich person deduction. In fact, just the opposite, as many high-income taxpayers have limits and cannot take as big a deduction. So if you are earning and not saving, you should think more about it. Save money, save taxes, and build an asset. It can be very important. How do you keep track of things that could be related to a tax deduction? Great question. It's so important to keep good records, and best practice to keep records for about 7 years in the unlucky event that you're audited by the IRS or need for other purposes, which today can be many. Many people say 3 or 4 years. I like 7. Clearly a bit longer, but really takes into account every scenario that could apply to you. And track everything related to your tax return, your job, your income, including things like prior year tax returns, receipts, canceled checks, health insurance documentation, and other documents that support any item of income, as well as any deduction or credit on your tax return. I recommend that you organize your tax-related documents into 4 categories: income items, deductions and credits, life changes, and finally other. Organizing this way not only helps you get and stay prepared, but it also helps prompt when you and your tax pro are together and you might qualify for a new or different tax deduction or a write-off. If you don't keep good tax records, especially when it comes to items you want to take a tax deduction on, and the IRS or state asks about it, you could run into issues. Your tax return could take longer to process, it could take longer to get your tax refund, or the IRS might even consider taking further action. It's best to talk to your tax pro to figure out how and what is the best documentation plan for you, or risk issues, penalties, or interest. One final important point. Do not keep records for longer than 7 years. It has very little benefit and carries a lot of risk. 7 years max. Have questions about what you could deduct on your tax return? Schedule an appointment with a Jackson Hewitt tax professional today at jacksonhewitt.com. And tell me in the comments, what's been the most surprising thing you found that you could deduct on your tax return? If you found this video helpful, please give it a thumbs up. Subscribe to our channel for more valuable information and hit that notification bell to stay updated on all things taxes. Schedule an appointment with a tax pro at jacksonhewitt.com today.